Apple stock is at all-time highs. This is the world's largest large cap company. Highest market cap, crossed over $3 trillion, and it keeps hitting all-time highs. Warren Buffett has been buying it, but I don't think at these prices. My personal opinion is he's buying it below 140. The interesting part is Apple's revenue in the last 12 months is down from the previous 12 months, and Apple's profit in the last 12 months is down from the previous 12 months. So if you're a beginner investor or an experienced one, I want you to stay with us this entire video. There's something in this video for everyone. We're going to go over the 8 pillars. We're going to go over some of the financials, the high-level financials. We're going to go over analyst estimates, bull and bear cases, some news, and Mo and I will talk about this company overall. Remember, there's something in this for everybody. We're going to cap it all off with our stock analyzer tool, which will allow us to make assumptions about the future. And based on those assumptions, it will tell us what price to pay. Because every investment is the present value of all future cash flow. And when you buy a stock, you're buying a business. You're buying a stream of cash flow. You're not just buying some ticker that goes up and down. So let's pull up Apple. Mo, you've got a big Apple position, but your basis is like $17.
Yeah.
F you.
Right.
So Mo's basis is $17 a share. So he's at exactly an 11 bagger right now, 11 times his original basis. All-time high was yesterday at 188.05.
Yep.
That is the all-time high.
Tracking
yesterday.
back up there today, 187.83. It's getting there.
5.5 months after hitting its 52-week low of 123, it's 50% above its 52-week low. It's 50% above the January 3rd price. So remember, guys, Mo has a position at 17. This does not mean you go buy the company because Mo has it. We're trying to teach a process here. We're trying to teach you how to fish. If you just want somebody to hand you fish, we're not the account for you. In fact, if you want somebody to hand you fish, none of the accounts out there for you because you've seen all the garbage picks all these other idiot financial guys have done. Look at Lordstown. A peak of 475. It just declared bankruptcy today. The stock's at $1.80. Nice work. So back to Apple. Let's go over some high-level things. This market cap means you're buying all the shares and you have to spend this much money to own all the shares at the current price. The enterprise value is right here. This difference is essentially the net debt. Debt, you add the market price, basically plus the debt, less all the cash. That's what you'd pay to own the entire company out free of debt. Mo, what are you smiling at?
I always look at a company like Apple and I go, why do you have debt?
Yeah, I know.
You know?
I know. It's a very good point because look at this. $97.5 billion in free cash flow in the last year, $84 billion a year for the last 5 years. And this debt is what? $100 billion. Isn't that crazy to even look at it?
Yes.
$200 billion.
I know. And you're like,
why even pay interest?
Exactly.
I don't know, Mo.
I've always wondered that with company like Apple, Apple specifically.
But I don't know, makes the CFO feel like he's doing something useful.
Maybe. He actually has to do something.
1 year PE 31, 5 year PE 38, gross margin 43. And look at this, a very high bottom line margin, even with such a low gross margin. Mm-hmm. So to go back to this, look at this, Mo. 0.5% dividend, but it still cost them $15 billion.
$15 billion.
And this is easily afforded because the 5 year average free cash flow is $84 billion. But back to this. Why would you pay a premium for a stock?
Moat,
which is indicated with what? What metric here shows us moat?
return on invested capital.
And look at the return on invested capital, 39%.
And that's higher than last year, actually.
Yes.
I think it was 38.
Because last year's return on invested capital is 51.4%.
Oh, I'm sorry. The average last year was about 37 or 38.
Yeah, the 5 year average.
Yes, correct.
So this return on invested capital says, hey, whenever we invest money in the business through debt or equity, we get a high return on it. That's usually very successful with companies that have a really large moat. Joel Greenblatt, in his book, the little book that beats the market, he talks about a high return on invested capital and a high return on assets being an indication of a moat. All right? You should pay a premium for that moat. This is the art of investing, though. How much of a premium? Because remember, it's not like Apple can just go invest $100 billion tomorrow in their business and grow profit by $400 billion. So let's say they invested $100 billion. If they were able to invest at this rate of return, every year, their profit would increase by $39 billion on that $100 billion. That ain't happening. No. Why? Because Apple's kind of run out of things to invest in. But it shows that if they do have an opportunity to protect their company, they don't have to invest as much into the business to do that. That's what's key. That's what's big. So you pay a premium for a company with a high return on invested capital, and you should also pay a premium for a company with a lot of growth potential.
Yeah.
Right? So let's go, before we get into that, let's go to the 8 pillars here and see what Apple looks like. So remember, if you have our software, you can customize up to 12 pillars and 4 quadrillion different variations of this.
He did not misspeak there.
Yeah, it's actually higher, I think. So we have all check marks except for 2 valuation metrics.
Yeah.
The 5-year PE, we want it less than 22.5, it's 38. And the 5-year price to free cash flow, we also want it less than 22.5, it is 35. Not gonna lie, I don't get this buying back of shares. I still think the company is expensive. I hope they're not buying back today's shares. But the good news is, Tim Cook, or as Mo likes to call him, Tim Apple, he's very active in talking to Warren Buffett. Warren Buffett has really guided him in capital allocation. What do you do with all this cash that comes in the business? What do you do with all this? And that's the big thing. When you buy back shares, assuming it's at a reasonable price, if you're buying back shares at a reasonable price or a cheap price, you're increasing the ownership stake of the other investors in the business. If a company has 10 shares outstanding and you own 1, you own 10% of the business. But if the company buys back 2 shares, you still own your 1 share, but now all the revenue, free cash flow is being split by 8 shares instead of 10. So now you own 12.5% of the business. That's how a company that doesn't have a lot of growth potential can increase its share price. But the key is they need to be buying back inexpensive shares. What does inexpensive mean? Well, you can't just go based on PE. It's also got to be based on other metrics like growth potential and return on invested capital. But that's what we're here to do in our stock analyzer tool later on in this video, to determine what is a cheap price for Apple.
They have been buying back shares each of the last 10 years.
What about quarter to quarter? Can you look at that?
That's a great
Because this year will be very indicative of what their plans have been.
Let's see.
Yeah, they're buying back
buying back each
They
quarter.
bought 100 million shares back.
Yeah.
It's $1.4 billion in the last quarter.
Yeah.
So they bought back 100 million shares in the last quarter, and at $140, $150 a share, or $160 a share, that's $16 billion spent buying what may be overpriced shares. We don't know yet.
So their most recent buyback, $90 billion announced Q2 of 2023, adds to the already $90 billion announced Q2 2022.
All right, so
I
don't know about that.
This one surprises me, and it always does surprise me when we do this video, because Buffett is in Tim Cook's ear, and Tim Cook asked for it. He said, "I'm not good at capital allocation. I know that's one of my weaknesses. Come and help me, Warren Buffett." And it's just interesting to see here the only time I can see in the past, 5-10 years was them realistically a good price of buying back shares was 6 months ago, 8 months ago, 10 months ago.
Yeah.
Unless I'm remembering incorrectly, but yeah, it's interesting.
So the buybacks are what they are. Mo, what are some bull and bear cases for Apple?
Yes, let's look at some here. So we all know, well, maybe we don't all know, China was a tough time. What happened in China during COVID was tough on Apple because they are very, very China-centric. So they're diversifying into India right now. They plan to invest about $700 million into a site and a plant in India. So they're going to be diversifying where they're making their iPhones. Smartphone market for Q1 of 2023 increased. This market share, their market share increased from 45% to 52%, and in second place is Samsung with 27%.
Wow,
that's a big jump. They do anticipate high sales for the iPhone 15. I think this one is a question mark, because if we do go into some type of true recession, not where people are saying we're in a recession, like people really cut back on spending, that's going to be one of the first areas that people are just not going to upgrade their phones.
Yeah, but Warren Buffett has a really, really good quote. He says, if you give somebody...
This is a good point.
If you gave everybody the option of taking away your iPhone or taking away your car, they'd be like, yeah, get rid of the car.
My only thing
is... that's a moat.
It's mine is the upgrading thing. Will people upgrade? Like if people have an
You're
iPhone
100%
13,
right. They'll wait a little bit longer.
I can wait another year.
Yeah, they'll wait a little bit longer. Look at Tim. Tim has the first iPhone from 1946, even before Apple became a company. Tim has the very first iPhone from 1946. It's funny because Tim runs our software, and he had this like dinky iPhone. And finally, he changed it out, and now he's like, "This thing's amazing." He's like, "I even hold my wife's iPhone." I'm like, "What is this piece of crap?" It's so funny. All right. By the way, do you remember how iPhone used to brag about how small it was,
Yeah.
and Samsung was so big, and now the iPhone's so big?
Now we're talking about folding phones.
All right, what else you got?
So bear cases. I think that this whole new VR headset could actually be somewhat of a bear case. I think they're pricing people out. I don't know if they're pricing it to sell to the masses, but it's gonna be cool. I'm not buying one. It's $3,000+.
So here's the interesting part to me. When I first heard about this, I was like, "That's too high." But then somebody said, "How many times did Apple come out with something and we think it's too much? People pay it."
100%.
But hearing Mo say it's too much, that makes me go, "Okay, it might be too much."
This is something I'm not even gonna buy.
Because Mo, yeah.
And I'll tell you why I'm not gonna buy it. I bought the Quest 2 for $400, and I didn't think it was worth $400. So there's no way for me to justify it and say this is going to be worth $3,000 or whatever the number is.
Yeah, maybe. Yeah, you're probably right.
I think this is going to be like the HomePod, and it was funny when I said,
"Oh yeah, the HomePod."
I said this is going to be like the HomePod, and Paul goes, "What's the HomePod?" I go, "Exactly." That's exactly my point. I think it's going to be that.
All right,
but there's some lawsuits flying around with Tim Cook and Apple and fraud, and I mean these are the normal things that happen.
So due to delays in mass production of new VR headset, they'll only get 2 to 3. Is this their way of saying we don't have the demand for it, and we're going to blame it on delays?
That's what I think.
Really?
That's what I think.
Okay.
I mean, I am so uninterested in this device that I didn't even sign up for the thing on the website that said, "Let us alert you of new news when it comes out."
Wow.
I don't even care.
Okay.
And I have every Apple product they make.
All right, let's go to analyst estimates.
All right.
So analysts expect the year ending September 2023 that Apple's going to make $6 a share. Okay.
Okay.
And in 4 years, $8.30 a share. So right now the company's at 185, 188. Divided by 831, what is that? 23 times PE. You might sit there and go, 23 PE isn't bad. Yeah, for 4 years from now. Mm-hmm. For 2027.
Yeah.
Now, guys, again, the moat is huge, and you should pay a premium for Apple. Warren Buffett paid a 30 PE for his initial purchase of Coke back in 1987. But the question is that justifiable? Go ahead, Mo.
I'm actually surprised that the numbers are so low from analysts because, number one, it's Apple. Number two, high return on invested capital, getting into new subscription areas. I'm surprised.
I'm actually surprised by this. Revenue growth.
I'm also surprised by that.
7%, 8% a year.
I would have thought they would have been putting like 70%.
Yeah. And the other thing is, though, but here's the interesting part. If revenue growth is 7 or 8% a year and they have a high return on invested capital, how is EPS growth with buying back shares barely above that?
Yeah. Yeah. I don't know.
Somebody's messaging me in the community.
All right.
I don't know. All right. So, guys, we've gone over bull cases. We've gone over bear cases. We've talked about a lot of things that if you're new to us or you're a new investor may sound confusing. It can be. It was for me as well. If you just subscribe to the channel and you watch more videos, it will make more sense as time goes on. Remember, our basic thesis is when you buy a stock, you're buying a piece of a business, and every investment is the present value of all future cash flow. Whatever you pay today, your return is going to be based on what you receive in the future. That's why we go to our stock analyzer tool. This is the most popular piece of our software. We have a lot of pieces of software in our tools right here. This is the most popular one. It was used 1.3 million times last year. I mean, I guess you'd argue that the community is probably more popular because thousands of messages go in here per day.
Yeah.
But this allows you, this stock analyzer tool allows you to make your assumptions about the future, and then it'll tell you 2 things. 1, what price you need to pay for the stock today to get those returns that you want. And 2, if you bought the stock today and these things happen, what's your return going to be? So it allows you to keep in perspective where the stock is today. So guys, if you like this, you like the tools, if you want the community of thousands of investors who are like-minded that you can talk to about your research and your ideas, go to everythingmoney.com, $7 for 7 days, $1 per day. It's a no-brainer. You spend $10 a day on most useless stuff in the world. This will change your financial future, get you all the tools and everything for $7 for 7 days, $1 per day. Check it out. Mo, let's do a 10-year analysis.
What do you think about for revenue
First
growth?
off, can I
Go
show
ahead.
this?
Yeah. Increasing
ROIC.
Yeah.
That's awesome. Now, Revenue growth. Go for it.
So I was going to do 4, 7, and 10. I think
Love it.
4 is low.
Love it.
But 10 is high. 7 is the sweet spot. Yeah.
Now, one of the things I want you guys to remember, a company, if GDP growth, nominal GDP growth, not real GDP, nominal, that adds back in inflation, if that's going to be 5 to 7%, a company like Apple should be able to do that in revenue growth. I think 4% is low, and I think 10% is going to be hard. But again, if they enter some other business that we don't see, or VR is way better, maybe they get there. I don't know.
Yeah.
Okay. Profit margin. Very consistent profit margin.
Very consistent, but I'm inclined to go 23.5.
As a low?
What do you want to go? You want to go where?
I want to go lower than that.
My only reasoning I don't want to go lower is they're really getting into the subscription business. That's going to not only hold their profit margin where it is, but
I disagree. I think
creep it higher.
Oh, I got what you're saying.
You see what I'm saying?
Yeah, but remember, we have to. I feel like for the low side, we should assume
What do you think?
the economy.
21?
I was thinking 22.
Okay.
What do you want to do for a middle?
24.
How about 24 and a half?
Okay.
No, 24 is fine. And then a high of 26?
Sure.
I agree with that because I think the subscription model, even though it'll add a lot, will add more. I don't know. That seems like if the last 10 years have been 23%, this is over a 10% increase in their overall profit margin. All right?
Yeah.
Free cash flow.
Same. I mean, actually, you can argue that it's just 25.5.
Yeah, I would just argue like 24, 26, and 28.
Okay.
Because we went
They've been
higher
incredibly
on.
consistent.
What was that?
They've been incredibly consistent.
And I like the
with free
fact,
cash flow.
guys, that their free cash flow is better than their net income.
Yeah.
A lot of companies have it the other way around, which makes you go, wait a second, why is that?
Yeah.
All right, PE. Now, guys, what PE will this company sell for in the future? Don't make your PE determination based on where it is today or the price of free cash flow. What I recommend is everybody start with historical average of 15 to 16, and you go up based on ROIC and revenue growth, and you go down for the same reason. If ROIC sucks and revenue growth sucks. But I think you start at 15. So, Mo, would you pay a premium to Apple or a discount?
I would pay a premium, but
I agree.
I was thinking about 16, 18, and 20.
Let's do it. I guarantee Warren Buffett does a higher amount.
Yeah, I agree with that.
I think he views Apple as like not quite as much as Coke.
It's 20 plus he's looking at.
I think so.
Yeah.
And the idea behind that, guys, for Warren Buffett, he's probably like, listen, I got so much capital sitting here. If I can put my money into a business that I think will be around for a very, very, very long time, and they're going to buy back shares, I'm okay owning this company and making 8 to 10% return.
And they're going to buy back shares when I tell them to.
Yes. And once he's still dead. Okay, so desired return, guys. This is your margin of safety. What return do you want? If you can get 9 or 10% from investing in a long-term ETF, what return do you want? Now, obviously, we've beaten up the company here.
Yeah.
So maybe we're okay with 9 or 10%. But as we go higher in our assumptions, we got to have a bigger margin of safety. And that's when you put the desired return higher. The more return you want, the less price you have to pay.
I was thinking 10, 12, and 14%.
I love it. 10, 12, 14.
Because I'd be happy to get 10% for those numbers.
Now I hit the analyze button. I want you guys to remember, stay with me through the entire end of the video because I add a lot of commentary after we talk about these numbers. But these numbers are going to show two things: a price to pay for the company based on these assumptions, and then based on these assumptions, if you paid today's price, what your return would be. Scroll down. All right, we got a low price of 90, basically 90, high price of 135 to 145, a middle price of 110 to 115 or 120. Now, if you paid today's price and the low assumptions occur, you're basically going to break even over 10 years. If you pay today's price and the middle assumptions occur, you're going to make about 6%. If you pay today's price and the highest assumptions occur, you're going to make about 10.6%. Remember, these are high assumptions.
Yes, they are.
That's the whole key here, guys. So for me, I have it on my watch list at 125. I know Mo's not selling it because his tax will take him down to 125 anyhow, so you might as well keep it. So guys, this is where we stand on Apple. Again, if this is confusing for you, watch more videos. I guarantee you'll get it over time. If you think we're crazy, I get it, but that's the art of investing. So thank you very much for your time.